Hi, I'm Sha'Ronnie Irvin, Tax Associate here at Traitlands Tax Consultants. Today we'll be discussing a federal tax update regarding whether an activity is engaged in for profit as to allow the expense to be deductible under Code Section 162. The agenda for this evening consists of an overview of the ability to claim business expense deductions as governed by Code Section 162. We'll also briefly discuss related Code Sections 212 and 183. We'll also discuss a recent tax court case involving the ability to deduct Code Section 162 deductions, which is the Mendhart case. We'll finish with the wrap-up. In general, Code Section 162 allows a taxpayer to deduct all ordinary and necessary business expenses paid or incurred during the taxable year and carrying on a trade or business. An ordinary business expense is one that occurs frequently or commonly in the taxpayer's business. A necessary business expense is one that is appropriate or helpful in carrying on a taxpayer's trade or business. Per Treasury Regulation 1.162-1A, the expense must directly connect with or pertain to the taxpayer's business. Similar to Code Section 162, Code Section 212 allows an individual to deduct all their ordinary and necessary business expenses that are paid for or incurred for the production of income or for the maintenance of property which is held for the production of income. Except as provided in Code Section 183, no deductions are allowed for expenses that are incurred in connection with activities that are not engaged in for profit. The term not engaged in for profit means any activity other than one in which deductions are allowed during the taxable year under Code Section 162 or paragraph 1 or 2 of Code Section 212. So for example, no deductions would be allowed under Code Section 162 or 212 for activities that are made primarily concerning sports or hobbies or recreational activities. The determination of whether or not an activity is engaged in for profit takes into account all the facts and circumstances of each case. Although a reasonable expectation of a profit is not required, there must be proof that the taxpayer entered into the activity or continued the activity with the objective of making a profit. There are 9 relevant factors in regards to the court case that we'll be discussing. Only 3 are really relevant of importance. The first one is the manner in which the taxpayer carries on the business, which involves whether they handle it in a business-like manner, whether they get rid of re-strategize if they see that something's not working out in order to increase their chances of making a profit. Another factor is the taxpayer's history of income or losses in regards to the activity. And lastly, the amount of occasional profits, if any, that the taxpayer that is earned from the activity. In 2013, the tax court on Mendhart addressed whether the petitioners were able to deduct expenses for their farmhouse under Code Sections 162 for the tax years 2005, 6, and 7. In the court case, married taxpayers were denied deductions under Code Sections 162 and 212 for their farmhouse expenses because they failed to prove that the expenses were associated with the rental real estate business or income-producing activity. From 1976 to 2007, the taxpayers periodically allowed their family members to live in the farmhouse rent-free, and other times the house remained vacant. According to the taxpayers, the family members provided services in exchange for the use of the farmhouse. However, the taxpayers did not report any income from these bartering transactions on their federal tax returns. They also failed to prove that the value of the bartering exchanges was equal to the fair market rental value of the farmhouse. That being said, the tax court found that the taxpayers did not do anything to generate any income during the tax years in issue, nor did they have any kind of reasonable plan in place in order to increase profitability in the future. In other words, the taxpayers did not make any effort to change their strategy after being unable to find a rent-paying tenant for over 30 years. So the taxpayers did not have a reasonable expectation for realizing rental income from the property. To summarize, the the Eighth Circuit Court affirmed the tax court's decision. To summarize, while the taxpayers contend that they bartered accommodations at the farmhouse for services, they did not prove that the farmhouse was a rental property which was used for the production of income. That being said, the taxpayers failed to prove that the expenses associated with the farmhouse were deductible under Code Section 162. Thank you all for coming.